So thank you, Marty, and thank you everyone out in Los Angeles. Appreciate it, and it's great. And I got to really say it. I want to thank Tyson. He's really helped on this panel and pull it all together. Um, as I learned yesterday, the important thing about the prep calls, Marty, is it keeps the moderator on target. Uh, you didn't know this, but we nearly dodged a bullet here today because I was thinking this was on Thursday and Friday.
Uh-oh.
And yesterday I learned from my panelists it's Wednesday and Thursday. So I apologize about any confusion that may have caused. So this morning's topic is new opportunities in the market. As we just heard from MK, the key word here is market, and the market is always changing, creating new winners and losers.
Hello.
It's also relative to other geographies. So that also creates winners and losers. Fortunately, Marty has gathered some of the finest minds here this morning to talk about this topic and more of the applied. You know, we heard from MK a lot about the economy and where it's going. So now what Tyson and Mitch and Richard are going to talk about are where are those opportunities and where can you find them and where can you locate them? My name is Mark Heil. I'll be moderating this panel. I'm managing director for Pickwick Capital Partners. We're a FINRA registered advisor to middle market companies and alternative asset funds, providing specialized transactional, strategic and transactional services. We provide a full range of investment banking and fund placement services. For the next hour or so, the panel and I are going to be having a conversation about opportunities in today's markets, including trading strategies, the wisdom of the 60-40 equity to debt model, inflation, interest rates, which MK just spoke about a few minutes ago, geographies, where to be long, where to be short, energy, and of course, AI, among other topics. All of us invite you to be part of this discussion. We would ask that, be polite, but don't be afraid to ask the question when it's top of mind. Don't wait for the end. So I would ask you to jump in. The only thing we'll request is that you'll be to the point with your questions, not give a long speech, introduction. Time is a valuable commodity. We only have an hour for this discussion. So we want to get everybody in and everybody's thoughts in. So with that, I think it's very important for a panel like this to remind everybody that information presented is for educational purposes only and is not intended as and may not be relied upon as tax, legal, or investment or other advice. To the extent myself or any of the panelists express an opinion as part of the discussion, those are our personal opinions and not necessarily the opinions of the firms they represent. I've given some quick introductions, but what I'd like to do now is introduce each of our panelists. And Tyson, I'm going to start with you. Tyson's managing partner of Income Growth Advisors. He's a registered investment advisor and got a CFA back in 1993. Now, for a little perspective, back in 1993, the new technology was the fax machine. So it was a while ago, but Tyson has a lot of experience. For the last 20 years, he's managed the Masters Limited portfolios. He's also the president of Optima Process Systems, an energy transition and process engineering startup. So he's got some very interesting perspectives on that. He's been featured in a number of news media outlets, including Wall Street Journal, CNBC, South Carolina Public Radio. In 1992, he was the winner of USA Today and CNBC Investment Challenge Options Division 1, achieving over 1,000% return on his project. He is a 5 times Seeking Alpha Editor's Choice, having published over 90 papers in that journal. Tyson, is there any color you'd like to add to that play-by-play? You're muted.
I've just worked on Wall Street, started on the floor for about 40 years and, sort of a student of the market.
Fantastic. Richard Gula, he's with Argyle Investment Consulting. Richard, I'm sorry to say, but nobody really cares that for the last 25 years you've been consulting to Fidelity, or that you've been bringing the perspective that reflects a multi-market cycle experience as a global portfolio manager, long-tenured stock or and its technical analyst, yeah, with a strong quantitative models and fundamental global macro grounding. Richard provides clients with customized stock selection and universe coverage, mapping price rotation with both low and opportunistic turnover portfolio environments. He's also developed advanced technical and algo trading systems, so we'll be very interested in hearing about that. And he's applied those to Bitcoin. So, Richard, nobody really cares about that. All they want to know is what the hell was Robert Kraft thinking when he fired Bill Belichick?
He was thinking that his son Jonathan and Bill supposedly the one factoid that appeared in the talk shows was that when they passed each other in the hallway, they never spoke to one another. And as soon as I heard that, amidst everything else, I said, it was really a succession battle, nothing else.
Fair enough. Any color you'd like to add to your very abbreviated background? You certainly have a wealth of experience.
Oh, only that I by chance and choice, always drafted the most talented owner, which frequently cost me getting any equity, but that's a minor regret. But beginning all the way back to Putnam in its heyday, in the Dean LeBaron at Battery March, and then a pretty legendary early international investor named Walter Oxley. He used to write for a number of used to write the column on international investing when only John Templeton cared. And but then I went off to Fidelity and worked for Ned Johnson and did a lot of custom projects. And then when I turned 50, everyone else was so young that I had to go hide. And but the older managers found me, and they've paid me for 23 years now to do custom work. The two facts that I would offer is that in most firms, outperforming on the downside doesn't get you a big bonus because there's no bonus money. So managers tend to be very aggressive on the upside. The other is that they run fully invested, and what I provide is a pretty unique way of finding new opportunities before the fundamentals have turned. But I've got both a quantitative and a pretty good price background, and so that's the field day for me was April of 2020. Everyone else was hiding under their desk, and Dean LeBaron said, on days when everyone hides under the desk, call them up. That's what I
did. Well, I will tell you, everyone want to have their cell phones ready and their pencils and pens ready when you speak. You have a number of interesting slides, and I think they're going to know that. Yeah, and joining Tyson's as well. But it should be a very interesting presentation when you and Tyson go through that. Mitch, I want to just turn over to you and chat with you for a minute or two. Mitch is the Chief Strategy and Research Officer for Elastic Cloud. He brings 25 years of experience from as a with the perspective of a trader analyst for a number of firms, including Jefferies, Everest Capital Partners, Equity and Port Elliott Investment Management, and of course Clarendon Global. So I'm looking very much to his. Mitch, I would suggest to you that your moderator is full of artificial intelligence, but maybe I would suggest you tell us about what Elastic Cloud's doing. That's far more impressive.
Okay, just so you know, I'm not real. I'm just an image right now. I'm somewhere else. Elastic Cloud, we're a high-tech outfit headquartered in London with offices around the world. We are a Microsoft partner in the AI journey, and we started that journey about 7 years ago. I joined the company initially as a startup, trying to get the company up and running as a CFO. The moment that job looked like a glorified accountant, then I geared over and used all my prior financial experience to saddle the company in a strategic route in our big AI journey. We had a little bit of a heads up because we were involved with Microsoft and OpenAI before most people even knew about this. But even then, we're talking about 3-4 years ago. We didn't imagine the magnitude and the size of what was going to happen. No one did, you know. So basically, that's where we are. My role there is to navigate, build partnerships, help Microsoft in their with their third-party vendors to identify opportunities in the marketplace, and that put me in a good position. You know, it's a good place to be. There's a lot of things going on.
Let
Um,
me let me ask you if I could just,
sure.
maybe you want to talk to me about, it seems to me we're very on in AI, and where you see this evolving to and what's going to happen and where the critical points like over the next 5, 10 years.
No one really knows when it's going to go because, for simple reason, uh, the pace of expansion is tremendously strong. Right now, for instance, we're talking about like Gen AI, but already we're waiting for first versions of Super Gen AI, which is going to be a couple of thousand times faster than now. We cannot comprehend how can this move. For instance, right now, we are probably where internet was in 1992. And chances are we will progress 15, 20 times faster than the internet revolution. So you can do the math. So basically, maybe in 1 year, we're going to be where internet was in 2000 something. It's hard to say. It's definitely hard to say.
I think that's fair. And I think it's very insightful and honest too. So we'll get into deeper discussion on the program, but I want to flip it over to Tyson now so he could take us through that presentation. Because I think building on what MK had spoken about a little bit earlier, again, this is more applied to where you can find opportunities and things of that nature. So Tyson, take it away.
Can everyone see me? Can everyone
Looks
hear
good.
me? Okay, not see me. Can everyone see the great rotation?
Yes.
Okay.
Yes, we can see you.
All right. Tyson Halsey here. So I'm just going to go through it. What I want to talk about, I think, has to do with recency bias, and that is a cognitive issue with how people think about things. And essentially, what the problem is with investing today is I think that we went through 40 years of declining interest rates, and we even had negative interest rates in the huge effort to lower interest rates in the post-financial crisis environment. And that created such a tremendous wind at our back in terms of driving valuations in stocks, bonds, and real estate that those asset classes largely became overvalued. And what I'm going to endeavor to talk about is what I call the flip side of negative interest rates. So where the markets are, what looks attractive, and what's the logical next step, given that we are now starting to see what are normal interest rates, not the artificially low interest rates of the last 15 years. And one of the things that we're seeing is gold and oil and commodities are starting to do well, and inflation is rising, which is a problem. So let's see here. One of my observations is I am a critic of 60/40. I think it has some problems, but I think that when you think about fundamental factors, I talked about the value of any sort of asset is predicated heavily on interest rates, certainly stocks, bonds, and real estate. But another fundamental factor is inflation. And there's an interesting chart here, which basically compares the S&P 500 versus the log of the PPI. And what you see is there are inflationary cycles, and I believe that defines the current economic environment. And I think it has a very definitive impact on how you want to think about allocating your assets. Basically, I think you want to be in commodities during an inflationary environment. And frankly, the reason to be in cash or money markets also makes a lot of sense, which is the flip side of what you get when you are in a deflationary environment. We saw a deflationary environment from 1981 till about 2000. Stocks went through the roof, but the contrary of that was in the 70s. Oil and gold, they did incredibly well. Also in the post-bubble period of 2000 to 2008, oil and gold did well, and the S&P 500 did poorly. And then subsequent to that, you had the S&P start to do well, the Mag 7, large cap growth. And now I think we're in a period where you will see those fade. And I think that oil and gold will, amongst other commodities, will be a place where there's value. One of the reasons that I say we're in an inflationary environment is very provably tangible, and that is we have higher inflation. The Federal Reserve decided that we could afford a little inflation, and with that, they changed policies that in combination with some COVID and massive government spending, we saw the CPI go up to 9% from 1.4% from January 2021. And then it started to decline. And then the idea that we would get back to a 2% level in inflation, really became the mantra of what the Fed was. But the reality of it is the CPI got to 3% last June. And the last read we had, I believe, was 3.5%. So it really has not even gone down. It continues to add already on high accumulated inflation over the last several years. And frankly, I have no confidence that inflation will go down, because when I went and studied economics at Duke University and graduated in 1983, we talked about something called supply side economics, and supply and demand determine price. And the idea there was create more supply and prices drop. When you shut down oil drilling and the Keystone Pipeline, and you don't allow for energy to be developed because you're putting in all sorts of regulations and pushing a green agenda, then oil prices go higher. And the consequence we're seeing, not only do you feel it at the gas pump, but energy prices seep into virtually every industry. And so consequently, there are inflationary pressures I don't see going away. And I think that that represents a problem. And something else not to
Hey,
feel.
Tyson, quick question.
Yes.
And I know it's, probably one that MK avoided, but, not only does energy prices impact everything, but inflation impacts everything. So in other words, when things become more expensive for the consumer, it's just not more expensive for the consumer. It's more expensive for the city that you live in, right? Even if you live in like a small town, things become more expensive for that city to provide the services it's provided for years, right? So just, thoughts on that? Just kind of it's a daisy chains, or I'm not sure what the exact phrase is. So.
The feedback loop.
Yes, a feedback loop, right?
So let me continue. So I think you're right, Marty, but let me talk about another problem that we're starting to look at. And what we're seeing is with higher interest rates, when you have 34 trillion in debt, the cost of covering that interest, your debt service, is now accelerating. Look at this. I mean, there was a point where you're at, a couple hundred million not so long ago. Now you're growing the debt at $1 trillion a year. Is what our debt service is on covering that 34 trillion in debt. And that is a problem. So again, I think that there's a critical timing factor that could be added into kind of any sort of strategic asset allocation policy, and that is the inclusion of commodities. And what I have here is a chart of the Goldman Sachs index divided by the S&P. And what you see here is in about 1998 till about 2008 or 2011, you had the prices of commodities going way up relative to the S&P, which went down, and that ratio did very nicely. All that started to reverse around 2011 when gold peaked, oil peaked in 2007. And then you were in a deflationary environment. And again, in that environment, if you're just in the S&P and the triple Qs, large cap growth, you did really well. I believe that that trend has reversed. We had a really big move in terms of commodity prices starting in 2020. And then we watched, particularly with Russia's invasion of the Ukraine, but then commodities actually have pulled back. But now I think that they've bottomed and things will continue to improve because the economy has not rolled over into a recession. I think that there is a risk, for oil prices to go higher. And one of the reasons is they simply have not made the capital investments that they have historically. There had been a big push for ESG and electrical cars, and that creates some supply issues. There are also geopolitical tensions: Russia, Ukraine, Iran, Israel, Iran proxies. I think all this, the threat of shipping of natural gas and oil, if there is a broader Mideast conflagration, I believe is the word, is a real one. And so I am not comfortable at all at this juncture that oil prices are going to go down, and I think that that's inflationary. I think that gold actually makes a great deal of sense. And what I've done is looked at the price of gold during these inflationary periods. And in the 1970s, we had our first kind of bull run, and gold actually annualized 37% on an annualized basis, while basically the S&P was flat during the 70s. And that was because gold went from $35 an ounce, and it got all the way up to $677. So that's 37% annualized. We had a similar run during the second inflationary period, and that was from 1999 till 2011. And that gold went from 256 per ounce to 1825 per ounce in 2011. And it's my opinion now that we are in a third move there. My colleague Mitch Balajic pointed out that the whole BRICS issue, or de-dollarization, is the way a lot of these BRICS countries are dealing with the currency issue is simply buying gold. We're seeing central banks, particularly China, buy more and more gold. And it is a historic fungible source of value and currency. And in my opinion, there's no reason why the move in gold couldn't go substantially higher. A lot of people brave, 2,600. I mean, I think it goes 3,000, 4,000, 5,000 an ounce. I don't know where it goes. There's a ton of money, and we got lots of weird things going on that might make this a popular asset class, and I think it should be included. So what I endeavored to do is actually compare those two periods and looked at what the S&P 500 did during the 1970s. It's not total return, it's absolute return annualized, 1.2%. And then during the second, from December of 99 to 2009, the S&P was down 2.49%. But during those periods, oil first was up 27% on average and 29% during the second inflationary period. Gold up 37% annualized and 17%. So if you were to take an average of those two commodities, 32 and 23%, and you compare that against the S&P, you're talking about a commodity alpha of 31 or 26%. These periods are not lined up perfectly, but the point is that is such substantial outperformance that I think that it makes a great deal of sense, and you can't fight the fact that inflation is going up. And I think that there's a compelling case for gold, commodities, and oil. And it doesn't have to be oil per se; it can be just energy in general. But for that reason,
hey Tyson, just a quick comment here. For years, we had the talk has been in economic circles of migrating away from the dollar, and migrating towards a commodity basket. Any thoughts about that, or is that just happening? as an underlying theme, or your thoughts?
Well, in reality, I see it happening in terms of international banks buying gold and wanting to hold on to gold and the risk of de-dollarization. Theoretically, it's above my pay grade to talk about a commodity basket, but the idea is that if in an inflationary environment, holding an actual commodity will have a real return where you might not have one in a financial asset. And I think that's the risk going forward.
Keep on going.
Going back to the 60/40, it's had a tremendous return, particularly on a risk-adjusted basis. William Sharpe, Harry Markowitz, two economics PhDs, really promoted the idea of 60/40 starting in about the early 80s, and everybody and their brother got into it. And I think that really this idea made sense then, but it doesn't make sense now. I can't really think of a compelling reason to own stocks or bonds. Doesn't mean that they're bad, doesn't mean you have to short them, but I can certainly see the upside being as much as the downside, relatively speaking. But the dirty little secret is everybody on Wall Street who makes most of us make a living, and we're not told to. We're not paid to be bearish. We're paid to accumulate assets and hold them. But I think that this is really kind of telling, and I got this from Shiller's website. Robert Shiller, of course, wrote Irrational Exuberance, which was published in March of 2000. But he looked at the S&P from about 1870 and brought it forward, and looking at those long-term trends really, I think, is important in terms of valuation. So in 1981, where I think things really started to kick off with inflation running out of steam, interest rates peaking, at that time, the S&P 500 was $119, $15 in trailing 12-month earning. It was trading at 7.83% of PE of 7.83. Compare that to where it is today, it's probably 23, 24, 25. And back then it had a 5.4% dividend. And back then, a 10-year U.S. Treasury gave you 15.15%. Now, if you read Shiller's Irrational Exuberance several times, he makes a compelling argument that if you want to make money in an asset, if you start out and buying it at the top quartile or top decile in terms of valuations, the odds of you're making money are really not that good. It'll take you a long time. 10 years, you might kind of be break even, which is what I think is more the risk today than historically. But basically in 1981, 60/40, that made all the sense in the world. And you didn't have to get a Nobel laureate, a Nobel Prize in economics to see that it made a lot of sense to pile into stocks and bonds then. Today, I just don't see a good case for it. Anyway, this is me. I'm going to switch to my colleague, Rich Gula, and he is going to go through a couple charts. Rich, are you there?
Yes, I am.
All right. So right now we have a chart of the 10-year U.S. Treasury note. What can you tell us about it?
Well, I think that if everyone has had an uncomfortable several years, they were, as we psychologists would say, you've got excellent reality testing. Basically, the 10-year yield has gone from 0.5 up to almost 5%. It may have touched it in the future a few times. Why that lurks beneath the surface, even with the recent highs in the equity markets, is because there's got to be some damage inside of a variety of fixed income vehicles that I'll give you a few ideas of where they might be. And the presentation I saw about 2 years ago, I believe, the early morning show on CNBC with Brian, whose last name I can't remember right away. Excellent show. He had on a fellow who knew the inside of the mortgage business. And he basically looked into the camera and he said, there are no bids on 3% mortgages, because mortgage rates then had been at 5 whenever that time frame would have been. Keep that in mind that therefore inside of funds that have exposures that reached for yield, quote unquote, which actually that they just invested in what was available back then, they are sitting in the marketplace that has not been very friendly. Next slide, please. My contention to the Fidelity clients was that the bull market started in 2020. The interest rate, now notice that I've highlighted 22 because that's where the interest rate increases began to wreak havoc. And that was declared a bear market by the folks that use the 20% drop as the parameter. I think under quantitative easing and with the volatility of quantitative trading, I would give a broader band. So if I was probably not going to go for a bear market unless you saw something closer to 30% in the averages. But that's just my thinking at the time. You can see that the rapidly rising interest rates did nothing to harm the S&P 500. And therefore, it's been one of the better bull markets in my career, even though it was very uncomfortable. Next, please.
That's Blackstone Mortgage Trust.
And this is probably one of the first places where this is the performance of that particular vehicle. And these vehicles were used in asset allocation programs, I am certain, inside the what we would call the wealth gathering firms that's everybody from Fidelity to Schwab to Vanguard. That there's something wrong here. The volume has increased greatly and now is beginning to sell off again, which is why I circled yellow down the bottom. This isn't just out of favor. This suggests that there could be a ripple effect somewhere, but we'll get back to that. Next slide, please.
That is the best zeros. The
yes,
25-year zero coupon ETF, I guess.
Well, I heard a presentation about 1990, mid-career, from Steve Luthold, a very well-known analyst who had very good reputation, especially for his data coverage. His primary trend indicator, like everyone else's, didn't always work as well as he would like it. And he gave a presentation in Boston at lunch, and he said, "I've made the most money in my career by going long zero coupon bonds in 1980. It outperformed everything." Actually, the best hedge fund vehicle would have been to short zeros back when rates began to go up. You can see from this is but this is both the affiliated asset classes in the derivative world that go with this chart have to be producing problems somewhere. And I think the Fed is quite worried about this on a sort of red telephone basis. And I was brought up, a very long stint in international portfolio management at Battery March, and I was in Switzerland a lot in the late 80s. And the Swiss fellows always told me to keep an eye on the Bank for International Settlements, which is seldom mentioned in anything that you'll see in our media. And I think they know where the problems are. Next.
And that is Boston Properties.
It's Boston Properties. A little news item flashed across LinkedIn a couple of weeks ago that a Canadian pension fund sold an interest in a property on Park Avenue South in New York for $1 to Boston Properties. And of course, everybody in real estate knew that they weren't taking a $34,999,999 loss. They were getting out from under a further commitment of about, I believe, around $30 million if they'd stayed in that particular investment. Pension funds, which are not talked about very much, except by good old pension and investments, which was a staple in my career in terms of reading. A lot of hard asset exposure there, either through private equity or through direct investment, like this particular fund. Boston Properties got something ticking in here that's not so good. And locally, I went to a presentation where from someone who managed one of the more successful buildings in Boston from scratch, and it still did, Don Shafaro, said that the vacancy rate in the financial district in Boston was over 35% right now. Next slide.
Rich,
Yes.
looking at this data, it's really interesting in that we're seeing some distress, obviously, in the real estate markets. But how are people making money in this, right? I mean, we're ultimately an investment group, and we look at opportunities for making money. I mean, lots of distress funds exist now that didn't exist in 2008, so those opportunities aren't there like they were then. So, your thoughts, or do we just have to wait?
Well, no. First, this is a bit of a good friend of mine was the Little All-America quarterback who said that when you're well ahead in the game or anywhere in the game, the first thing you do is figure out how you don't want to lose the game. And with markets sitting at all-time highs, the first thing that I would urge is that you want to go through your holdings, no matter how large the pool that you're speaking of, and make sure you don't have some exposure where there's a ricochet effect here and a derivative problem that goes out. That said, there are real estate exposures like equity residential that are in a whole different part of this marketplace. So there's a big opportunity for two things. Number one, have that exposure. And the second is my old contrarian value ideas. I'd love to see a hard sell for 2 weeks and high volume in all of these funds, and I'd be a buyer of them because I don't think the Fed's going to allow this to turn into mushroom. They will save whatever the problem might be. So you're right. You're waiting on that basis. But I think that I didn't put in charts of things like the State Street real estate ETF. None of those are very attractive on a trend basis. But if you have a 5 to 10% contrarian corner in your portfolio, regardless of the size, I'd be working very hard in there and look for things that would come down hard, and I'd be buying into that. But that's my instinct. That may not favor if you're going to make money, the money's going to go somewhere, and it's going to go into the next few slides, which you'll see a very different picture. So go buy copper, and the
Southern Copper Corp is the chart.
This is the old Southern Peru Copper, I think, that they changed the name a little bit. The Peru ETF has outperformed the S&P over the cycle. And there are a variety of copper and commodity funds that allow this kind of exposure.
Well, I'm sorry, what's the outperformance amount? By 5%, 10%? How much?
I think that when I calculated out the Peru ETF was up over 50% when the S&P was up more in the 35 range. I'll get the range.
Interesting.
There's not much liquidity there, but you want the ETF to go with the commodity. Otherwise, it could be somewhat spurious, if you will. Next.
I have a question.
Sure.
What ETF, do you know of any ETFs that country ETFs or other ETFs that would represent gold other than GLD and IAU?
Well, in the old days, anything from, if you found the right ETF in Australia, it would have to have a pretty good exposure. And I grew up in the era where East Dryfontein and West Dryfontein, if anybody out there has as much gray hair as I have, you might remember those names. They were South African golds that are long gone that yielded 10% and went with the price of gold. The only thing I don't like about gold is that there are several stocks that have gone with it. There's the GLD is the standard ETF that buys physical gold, and there's a GLDL, which is a micro version of that. I guess if I had a problem down the road with settlements, I would want the folks at Goldman Sachs to go get my money for me, which is why I'm showing the chart of the Goldman Sachs fund here. But I'm not. This is kind of support of Tyson's idea. I don't have any clients right now that have significant interest in that running domestic equity funds. So it's not something that I've kept up on in that way. But if you get back to me, I'll be glad to go and poke. I'm interested myself.
I would also say it's important to distinguish between gold equities and gold itself. When you're buying, like, I forgot some, they're too physical, but GLD is a physical. But you can own GDX, which will give you broad exposure, and I can also get back to you with some other gold names. But what's interesting is actually the gold itself has rallied, but the stocks have not. And the important thing there is that simply means that your gross margin, we know, is going to expand. And for whatever reason, I think that there's a real compelling case to get into gold and just be there. When I recommend gold, and I do use basically the commodities, but I think owning the actual stocks makes sense. And I tend to take more of a diversified approach, own both the physical as well as the stock. But clearly, when you can see that when you used to be selling gold at 1,800 an ounce, and now you can sell it at 2,300 an ounce, you picked up $500 per ounce in gross margin that drops to the bottom line. So, and the stock hasn't moved, but gold has. No, that's a no-brainer. That's buying value. Actually, the valuation on gold stocks is incredibly cheap across the board. And like Rich, if you just tell us, Marty, you can, whoever you are, we'll send you some names and ideas to supplement that investment.
If you wanted to quote unquote diversify your exposure, you could use a couple of those ETFs. Let's say you're going to put a quarter into we'll trust our friends at Goldman Sachs to get your money back if anything goes wrong.
Folks, we got about 10 minutes.
Okay, yes, but there are two stock names, Agnico Eagle and Newmont. Newmont is trailing, and Agnico Eagle is broken out pretty well. But I would own both of those. So next up, we can.
All right, and then
we got to finish this up, guys.
Yeah.
All right.
Uranium.
Cameco.
Do uranium, and we can do. I'll do the rest of the slides quickly. Do uranium and for that exposure. And if you need some growth, then go to Ferrari. I probably chose it because of the symbol. And last but not least, what is
Kellanova? Or is that Kellogg? Kellanova?
No, that's Kellogg. Staples. The Staples are probably going to kick right back in here. The institutional world is not going to go to cash, so they'll rotate out of consumer discretionary into Staples. Anyway, thank you very much.
Oh wait, the
that's those are the levels of PE. If you go to the 255 IBES estimate, I'm a IBES fan because I grew up with IBES from beginning of my career. So if you get a 22 multiple a year out, you'll be at 5610, and that's the closest outcome to giving a forecast.
All right,
wow.
I'm going to stop sharing, and we'll go over to Mitch. Mark, you want to pick it up?
Sure. Well, first off, thank you for that. A lot of interesting things in there. Mitch, you want to talk a little bit about what you're seeing currently in artificial intelligence, and particularly, we're talking about economics here, and I heard Tyson reference one of his teachers, and one of the things that my economics teacher drilled into my head when I was taking economics around the same time Tyson was that when you have your guns, you have your butter. Meaning when you have during war times, you had higher GDP, higher employment. You're also developing technologies faster. And many people believe that, World War II pulled us out of the Great Depression. So one of the side effects of these wars that we're currently in, and certainly of what we're going through right now in the military complex and things of that nature, is the development of a lot of exciting technologies that are changing the way business is done. And I think AI fits squarely into that. So you want to talk a few minutes about where you see AI today, where you see it in a couple of years from now. I know we sort of touched on this at the beginning, but we're going to drill down a little bit and just chat.
Okay. Do you want me to go quickly over my presentation and focus on
Do you have
the
one?
questions?
Perfect. Do
Yes,
it.
Yeah,
Yep.
we've got about 10 minutes. Yep. Mitch.
Okay, I will do it. No problem. I will do it very quickly.
No problem.
Yeah.
Okay. Just a little footnote. I didn't have time to put this into a PowerPoint because I thought this was tomorrow, not today. But it doesn't matter. My presentation is going to be short, same. I'm just going to be talking about important points, including your question, and just go over some graphs and currently what are we seeing today. Just going to do 4 quick segments, just framework, comparison, and views as an introduction. Then very important just to explain a little bit how we look at the supply side, the AI solution provider versus demand side, enterprise solution adapters, very important. A little touch on evaluating AI ETFs and why they are absolutely problematic these days. And then a little touch on the markets. But this is a long document, but as I say, I'm going to be jumping very fast through it and focus on the important points. And I know, Mark, you already asked me twice, where are we going with AI? And that's a question that really no one wants to answer because of the speed. But let me just go through this very quickly. First of all, when we talk about AI, just to be on the same page, there's different aspects of AI, typically based on capabilities and functionality. We are really focusing, and the big talk of the town is the generative or general AI, which is really my focus as well here. Very important to distinguish this people are mixing up like generative versus predictive, generative versus disruptive technologies, difference between demand, supply side, and whatnot. This is exactly what a lot of these ETFs are really failing miserably. The views, we all know AI is here to stay. It's a grand thing. Some are skeptical more or less. I just broke down, I will have this document available. I'm not going to read this, but I actually said, but why is it here to stay? So I came up with these 10 bullet points that really, when you summarize all 10, you realize, yes, this is real, not an investment suggestion because no one really knows how long will it take to really get into full speed. Supply side, very quick view. When we talk about supply side, we're talking about Gen I tool economic chain horizontals, which is expanding dramatically. We're getting every day like dozens of new companies coming out and then within months becoming unicorns. Application layer, middleware layer, foundation model layer, infrastructure layer. I'm not getting into details. That has expanded also vertical into industries. Now we have companies specializing in specific industries. So we're getting into details here. Why is this important for investors? To really understand these companies better, market differentiation, revenue and profitability, risk assessment, investment opportunities, strategic partnership, then all comes in for you really to have an overlay to conventional analysis that you're performing now in stocks. Way to play the space. Unfortunately, a lot of these companies are private. Unless you're a private equity investor, you're going to have a very short list of listed companies. However, these listed companies are good proxy and benchmarks. And I have a list here, the ones in green, those are the list. This is the segmentation that I created on companies. The ones in the green cells are the ones that are publicly listed. And in my view, these are companies that are going to do very good. This is my pick. And if you're looking at publicly traded companies, the focus is on the ones in the green cells. Demand side, this part is not covered very well simply because AI is not mature yet. The first phase of AI was really euphoria. We're coming out ChatGPT, this and that. Developers developing cool stuff, which is a red flag for me always been. Now we're moving, and since about 6 months ago, we moved into another phase. And these 3 key takeaways are very synergetic and very similar, and they really explain where does corporate America and the corporate world, not just America, stand. One is, where's the money? Where's the ROI margins? Well, you're not going to see ROI margins because mainstream adoption is still years away. And initial enterprise use case is still being proved out, problematic, which comes to the point, AI convention still remains very high, but market is gravitating the fast twitch, the low-hanging fruit, which is dramatically changing the business models in the last 3 months, and also requires a different way to look at companies. Now we're saying, okay, this low-hanging fruit model, the companies who adapt this are the ones who are going to be making a difference within a year, not 2, 3, or 5 years. And this is some of the charts to keep in mind. This is the adoption. So if one tells you AI is going to be great, of course it's going to be great. But right now we are right here, early adoption phase, which means that it'll be another up to half a year to 2.5 years. Then comes the growth phase, maturity phase. And that goes hand in hand with this chart. This is the long-term productivity chart. And if you see since 2007, since the recession, it has been in a range. When I saw this chart, for me, this was very telling because AI is going to break this to the upside. And chances are we will have this type of productivity in a sharper angle given the AI. I truly believe in that. And then you can do the math. If productivity does skyrocket with AI, then you can do the math of the evaluation of stocks, industries, the whole market, and so on. I probably don't have time to explain this chart. I'll go very quickly.
You got about 5 minutes.
Okay, that's fine. So this is quickly. So how do we allocate these low-hanging fruit, this kind of first adapters, this first results, first companies that are going to stand out? 3 things come to mind. The readiness factor. Companies and industries need to be digitalized to actually go into AI adoption. You cannot adapt PDF files. Second thing is you need to have a certain percentage of costs related to something Gen AI can replace. And that's the thing. And then there you have, that's the pulse. And then you have the actual strategy. Which companies, which sector are progressing? And if you look at here, this is scale 0 to 100. And the most progressive AI adopters like technology and financials are only 23% there, which just confirms this graph here. We are at early stages yet. And I mentioned early in the call, we are at 1992 internet right now. And of course, there's also a question of revenue, costs, and competition. Cost goes down. Yes.
If I could ask you, so 22% of what? 22% of 100, but what's 100 represent?
100 represent a hypothetical that your complete operation is anything that you can implement efficiently and fully. AI is considered 100%. Of course, no one's going to be 100%, but let's say the suggestion is that companies can accomplish 70, 80%, but we don't know how efficient AI is going to be to really go beyond that border. The point is, this is early stage, so, and this is hypothetical.
I got that. I just wanted to understand what what that 100% represented, because
that's like full. That's like we are fully automated, we're fully Gen AI, we can't do more and so on. Now, here's the interesting that we came up with. So cost goes down, as you see the column here. Revenues, not necessarily. Like insurance industry, we came across it, the revenues are going to go down. Yes, we say, well, how's that possible? Because of competition. One thing that's not accounted into this phase is competition. The barriers of entry are dramatically dropping now, not just inter-industry, inter-sector, inter-market, which is also going to be a big disruptor that I think people didn't into account. So that's the stereo. That's like the steroids coming into the marketplace. There's a lot behind this chart, but I'm not going to get into details. I don't have time. And here it is. This is like assumptions. So we took numbers. And we took these percentages by company, by industry. How much of this cost is going to be cut based on AI in like labor related, non-labor related? And the numbers are very, very impressive, because if you look at here, like let's say consumer discretionary sector, right now in margins 10%, conservative scenario will go to 25%. So if your margins go up 150% change, and that goes across all sectors, then you can again do the math. I mean, this is the best case scenario. It'll take years to accomplish, but we are heading in that direction. There's no question about it. Is it going to be this much? Is it going to be good, excellent, fantastic? We don't know, but it's going to be at least good. That's something we can say.
We got about a minute.
Got a minute. Okay, so let me just dash down. Okay, so this is the companies we came out as that identified. These are the maturity companies, mostly larger cap. They're identified that fall into the group. They're ahead of the curve. They're actually very mature as AI, and probably, which means they will be eating someone else's lunch within their peers and competitors.
Have you ever looked at the tech model for corporations? Because most corporations spend about, so they spend something like 5% of revenue on tech. Of that 5%, 95% of that is just to maintain existing systems. So they only spend about 3 to 4% on buying new systems. So I have a hard time understanding this AI model where they're going to grow so dramatically because a lot of the budget's are already spoken for.
No, they were, but a lot of these budgets need to be changed because one thing people forget that we still live in legacy models. Like the insurance and the finance sectors infested with legacy, with billions of codes of like COBOL, Fortran. We're talking about, you can't find a programmer younger than 65 who understands this. But you need to fix this before you can get it. But the good thing about AI is an overlay now that's going in there by itself and fixing everything and translating languages and whatnot. Budget reshuffles are going to have to be made. So if you're not aware of this, you don't have available cash to make this adaptations, and your competitor does, chances are, he'll be eating your lunch.
Fantastic,
so, yes,
great.
Yeah,
well, that's all the time I have. So
okay.
Change has to happen. Is there any way that you can make cuts to this and send it to the group before the day is over?
Yeah, I will.
If you can share it, that would be fantastic. I think everybody want to download it. If you can send it to me, I'll post it on DocSend, and then I'll share it with the group repeatedly today and tomorrow.
Okay. I was almost finished anyway. I went through it really fast, but I will send this document. I'll share it. And if there's any questions or follow-up, just let me know.
Fantastic. Great. Thank you so much.
You're welcome.
Thanks, guys.
Thank you, Marty.
So I guess, I before I started this business, I worked at JP Morgan, was one of my places that I worked. And JP Morgan is just an agglomeration of a bunch of other banks that they never moved any of their coding from anywhere. It's just all the old computer systems that they've had for years. So, and a great story I'll tell you is that my dad was a aeronautical engineer for Pratt & Whitney designing supersonic jet engines, right? And they all did it in Fortran back in the 70s. So Jimmy Carter came in, he fired everybody, right? He cut military budgets to the bone. And you guys would know, if you're an LA guy, you would know that tech got cut back in the 70s dramatically with Jimmy Carter. So my dad went to Brazil and worked for the precursor to whatever the big Embraer was and taught people how to do aeronautical engineering. And he came back because Reagan came back in office and started spending on military like crazy. And all the engineers had found other jobs. They were like, working at casinos, selling real estate, whatever. And my dad was the only one who remembered Fortran. And all these Fortran models they needed to support, and he made a fortune. It was ridiculous. That's like he was like 70 in programming Fortran. So these old systems, they never go away. They stay in place. It's a crazy thing, right? Ron, you had a statement?
I comment. I think it's we're personal. We're experiencing that. I think the programmers Tyson in the U.S. is way overpriced compared to the rest of the
Sure, of course, yeah.
So that's going to change very dramatically with offshore sourcing. And then AI code, at least the QA side, quality assurance is definitely AI is better than people. And the automatic code generation by AI is also extremely already practically done. I think what we're also seeing that, what's important is the architects. So you don't really have good software architects. And that's what the university system in the US did not do.
I think the regulatory environment really matters a lot with AI, especially with fintech.